Is the next 12 months going to be your last buying opportunity as we head into the next few years? If you're wanting to find out more, make sure you stick around. Guys, welcome back to the channel. My name's Julian. I'm the head of strategy here at Ripehouse. And in today's video, we're going to be unpacking what might be happening in terms of the affordability and interest rate space in property segment over the next kind of 12 to 24 months. If you're new to the channel and you haven't already, make sure you smash that like button to hit subscribe, because here we talk about property and all things finance related to property. But I guess in today's video, we kind of want to talk about where is the market heading over the next kind of 12 or so months, and why in particular these next few months that we're leading into right now might be the limited opportunities that you still have to get into the property space, because we are seeing significant increased of buyer interest from the investment side. And that's off the back of things like, we are seeing interest rate cuts fixed in to your fixed products, so your 2, 3, 4 year loans, they're coming down. You're also seeing your saving terms deposits, those interest rates are coming down as well, being offered by the banks. And that's essentially the banks saying we are anticipating there are going to be rate cuts. Now, whether that's next month, whether that's December, whether that's early next year, the bank's economists, which normally quite accurate in terms of predicting where interest rates are going to go, property prices is probably a different thing, but they see all the live data, they're seeing people's spending coming down, and they are almost certain that we're going to see some rate cuts coming through in there. And something else that I think is worth taking note is there's been a lot of talk probably over the last couple of years of investors getting out of the market. But the newest data is showing that investor demand is increasing, and there are far less investors actually selling their investment properties because they, whether they're taking advantage of some of these 12 or 24 month fixed rates to reduce their operating costs, but they've maybe gone through the pain and they are starting to think, well, hey, if rate cuts are on the horizon, I'm potentially an experienced investor. I know what this normally tends to lead to, and I want to still stay on this ride for the next wave that's going to come through. So, and that normally means if you've got less investors selling off, particularly when we already know the data on that there's not enough homes being built, well, that means that listings are going to start to dry up, because we saw a little bit of an influx where, so maybe there's been or it's always picks up during spring, but if investors aren't adding to that listings, then what's going to happen is, as demand will increase when rate cuts do arrive, less listings mean there's more demand than there is supply, and that normally leads to one thing. So another thing I think to take kind of key note of here, if we take a bit of a look at the consumer confidence index. So that is essentially how confident somebody is to jump in and out of a market at certain times, because whether they feel wealthier, whether they're feeling that the economy is really strong, businesses, etc. If we look at this one here, and we've gone through this chart on the channel in older videos, but if we want to just maybe look in more of a shorter time period here, we can see kind of we're just coming out of the pandemic a little bit earlier here, but we're at pretty low levels here. But we then had that bit of a spike. We had, JobKeeper, JobSeeker, some the building grants introduced, and we saw consumer confidence go up through the roof. And in that same period of time, it's no coincidence that as consumer confidence rose, that house prices also started to move, because if you're feeling confident of a market, you're then more likely to open your wallet, open your bank account, and get out there and spend and buy, right? So, but what ended up happening, we saw interest rate hike after interest rate hike after interest rate hike, and we basically fell to the floor. So we had a record-setting amount of hikes over a period of time, and the consumer confidence fell to the floor. And what steadily happened is that we've had a bit of an increase month by month. This here is essentially not rate cuts happening. These are been predominantly rate holds. We then had, I want to say maybe August or November, where we had our last rate hike. And that's when the rising confidence almost took a bit of a dip, because at that point, I think investors thought that they were going to get their cuts, and the RBA came and said, no, one more hike for you. That kind of stopped the momentum for a little bit. But now, as there's been holds, it's been slowly creeping its way up, and we're back heading towards, we're at that 99 line. And I can almost guarantee, if there was a betting line, I'd be all in that if we get rate cuts, consumer confidence will be back towards that 100 number, even higher, and that will accelerate your your price movement. Because I think it's understanding what do rate cuts bring into the market. So firstly, as those who have been on the sidelines and seen rate increases essentially evaporate your borrowing capacity, a lot of people have lost 20, 30, 40% of their borrowing capacity. So rate cuts increase your ability to borrow. And if you've got increased borrowing, it essentially creates more demand, because you might have been in the market looking to buy a property, whether it's $400,000, $500,000, $600,000, $700,000, but you couldn't afford to buy it. So all of a sudden now you're able to get that servicing and give you that ability to lend and buy. And then that essentially creates more demand. And when there's more demand, well, that more demand normally means to price movement. And price movement then ends up inadvertently taking opportunities away, because whether you're competing with more, even though there's just as much supply on the market, so there's less opportunities for you. But it's also understanding that some of your opportunities, particularly at the entry level opportunities, they are going to dry up, and they're going to dry up really quickly. So before making this video, I did a little bit of research in terms of went through the algorithm, had a look through the data as it sits across the country, and just more of an FYI for people following along at home. There's over 15,300 suburbs across all of Australia. Now, in terms of approved locations and what we have deemed as investment grade opportunities in the market, we have 40 suburbs across the country at the moment that are between that $400,000 to $500,000 price range. Now, keeping in mind, they might only get a listing a week, if that. Do they pass all the criteria from investment grade perspective? Are they in good condition? There's a myriad of hoops that they've got to jump through, but it's not going to take much where, if we do see all of these things take effect, where we see increased borrowing, we see increased demand, we see that price movement, where those $450,000, $400,000 properties, they come up 5, 10, 15%, and those entry level opportunities at that $400,000, $500,000 price point, they no longer exist. So in my mind, where we kind of need to be thinking where to from here is, and this is even for me personally, I am been kind of scraping and clawing over the last little bit. I'm trying to pile in, whether it's myself or assisting family or friends. I see that this might be the best or last buying period we have potentially forever at that affordable level. So if you are kind of sitting on the fence, we're going, well, I want to wait for the next rate cut or see what happens, I can guarantee you that there are just as many people like yourself in the same situation thinking that as well. And all that's going to end up happening is that $400,000 asset you're looking at buying today inadvertently becomes a $450,000 or a $500,000. So you just end up paying more for the same opportunity, and you might then end up getting just priced out of the market. So initially your serviceability was pricing you out of the market. Now the opportunities and the pricing window is going to price you out of the market. So I feel that I think the next 3 to 6 months are the best windows to try and buy right now, ideally probably closer to the 3. But in the next 12 months after that, it could really start to dry up. But I'd love to know your thoughts and opinions on this. If you haven't already, make sure you like and subscribe. Make sure you leave a comment. Maybe you think you completely disagree, but I'd love to know more. So other than that, guys, we'll see you on the next one, and that's it. Bye for now.